The closing bell rang just about 15 minutes ago, wrapping up the Wednesday, July 1st, 2026 session, and I want to jump straight into the scoreboard. The S&P 500 closed down 0.22% at 7,483.23. The Dow barely budged, dipping just 0.03% to 52,305.24. And the Nasdaq took the real damage, dropping 0.70% to settle at 26,040.03.
Yeah, if you just glanced at those closing prints on your way out the door, you'd think we had a pretty ugly broad market sell-off on our hands.
Right, but that's exactly why we're doing this deep dive today. Looking at those top-line numbers is like, judging a book's entire plot by a dark cover. Because the red on the screen is hiding what was actually a massive violent rotation happening right under the hood.
Absolutely. The narrative today wasn't a panic. It was a highly controlled head fake. You've got to remember, these major averages are cap-weighted, right? So they're heavily swayed by just a handful of tech giants having a terrible day.
Which drags the mathematical average down, creating that illusion of universal selling.
Exactly. The real money didn't vaporize today. We just saw a massive internal shift of capital away from AI hardware and straight into safety. But before we get into the internals, we have to talk about volume confirmation. Or, well, the lack of it.
Yeah, the volume was absolutely abysmal today.
It was a ghost town. The S&P 500 traded only 3.66 billion shares. And for context, the 30-day average is 5.55 billion. Wall Street is already packing up for the Independence Day holiday.
Right, with Friday fully closed and Thursday being an early bond close, liquidity is just evaporating.
And in a low liquidity environment like this, algorithmic sweeps and large institutional block trades just dominate the price action. That's why the tape was such a choppy mess today, rather than a high conviction trend. A smaller amount of money pushes a stock much further.
Which amplified all those intraday swings. But I want to talk about the macro digestion because the data we got this morning was completely mixed. We had weaker than expected ISM manufacturing data come in at 53.9 versus the 55.7 estimate.
Showing the economic engine is definitely cooling off a bit, which organically pulled the 10-year Treasury yield down to 4.48%.
Right, which normally gives equities room to run. But then, new Fed Chair Kevin Warsh is over in Portugal, basically playing bad cop on inflation.
Yeah, he completely refused to commit to a July rate cut and doubled down on that strict 2% inflation target.
So let me unpack this, because we have bad manufacturing data and a hawkish Fed chair. By all traditional metrics, institutional money should be running for the hills.
You'd think so, but they've been heavily conditioned by this bad news is good news psychology. Institutions did fade the midday rally. I mean, the S&P peaked at 7,521.81 before they sold it down into the close.
But they didn't panic?
No, they didn't liquidate. They executed a highly controlled risk reassessment, which leads us to the internal breadth, because this is where the real story is hiding in plain sight.
Right, the reverse divergence. I want to highlight a mind-bending stat from the institutional wraps. Despite the S&P 500 closing in the red, 3 out of every 5 stocks, 60% of the market, actually closed higher today.
It's wild. 7 of the 11 S&P sectors advanced.
The advanced decline ratio was 1.8. It's a total reverse divergence. The headline says there's a thunderstorm, but in the background, 60% of the market is just having a sunny pool party.
And that pool party was heavily concentrated in defensive consumer staples. In a choppy tape where macro signals are conflicting, smart money buys boring, profitable predictability.
Which brings us to General Mills, ticker GIS, the absolute poster child for today's rotation.
What a move. GIS gapped up and closed 8.33% higher today at $37.70.
For a massive, slow-moving cereal company to jump 8% in one session, that's huge.
Well, they delivered a massive Q4 earnings beat 95 cents against an 81-cent estimate. But the real catalyst was the structural guarantee they handed the street. They announced a $3 billion cost-saving plan stretching through 2030.
So they basically handed institutional investors a roadmap for protected profit margins.
Exactly. When tech is violently selling off, investors are more than happy to hide out in serial dividends and predictability.
Let's pivot to that tech sell-off, though, because we know where the money went, but we have to look at the bloodbath it left behind. The cap-weighted indexes were dragged down by an absolute earthquake in AI.
The meta bombshell.
Yeah, Meta Platforms, ticker Meta, surged roughly 8.4% today to close at $613.34 on absolutely massive volume. And the catalyst was a Bloomberg report that they're launching Meta Compute.
Right, they're going to start selling their excess AI computing capacity and offering model as a service to enterprise clients. This completely rewires their narrative.
It's insane. Think about it like this. Imagine your biggest, most lucrative customer suddenly opens a rival store right across the street using the exact equipment they bought from you. That is what just happened to the entire AI cloud market.
Meta morphed from a consumer of compute into a primary competitor, and the slaughter of the suppliers was immediate. Pure-play neoclouds just got crushed.
Yeah, Nebius down 17.01%, CoreWeave down 13.92%, IRN down 5.27%.
Because if you're an enterprise customer training an AI model and Meta is suddenly offering up their world-class idle infrastructure, these smaller neocloud middlemen just cannot compete on pricing or scale.
And the blast radius didn't stop there. The semiconductor space was hit with incredibly aggressive profit-taking. The SOX index plummeted 6.5%.
Because if hyperscalers like Meta have so much excess capacity they're renting it out, the market immediately starts pricing in a demand cliff for new chips.
Right, which explains Lam Research shedding 9.71% and AMD falling 6.89%. But the absolute epicenter was Micron, ticker MU, which collapsed 10.57% to $1,032.28.
And the mechanics of that Micron drop are crucial to understand because it was heavily algorithmic.
Yeah.
You had news of the CEO's insider selling hitting the wires, combined with reports that Michael Burry is shorting AI chip leaders.
And algos just scrape those SEC filings and news feeds, right?
Exactly. They scan for keywords like Burry shorting and instantly execute massive sell sweeps. It triggers stop losses, forcing more selling, and suddenly the AI trade is fracturing and cannibalizing its own suppliers.
Okay, here's where it gets really interesting for me, and honestly, a bit confusing. Tech is bleeding out, semiconductor supply chains are collapsing, but the VIX, the market's main fear gauge, actually fell 1.34% today to 16.23. It's on a 4-day losing streak. How is the market this calm?
That is the defining anomaly of the session. You have to look at the spread between the VXN, which is NASDAQ volatility, and the VIX.
And what's that spread at?
It's sitting at a 23-year record of 12 points.
Oh, wow.
Yeah, so broad systemic risk is viewed as non-existent. I mean, the S&P is only 1.66% off its record highs, but tech-specific anxiety is at a historic premium. The market isn't scared overall, it's just specifically terrified of tech.
So they're dumping broad market hedges and paying a massive premium for targeted NASDAQ insurance.
Exactly. And to prove that smart money is highly confident buying structural value outside of tech, we just need to look at Nike's chart today.
Oh, Nike, ticker NKE. Yeah, that was wild. They hit a painful 12-year intraday low of exactly $40 this morning after Q4 earnings showed a 17% drop in Greater China growth.
Normally, hitting a multi-year low on bad fundamentals triggers total capitulation, but buyers stepped in and aggressively defended that $40 floor.
They didn't just defend it, they completely overpowered the sellers. Nike erased double-digit losses to close up 5.09% at $43.14. And the volume, 74.5 million shares, which is 181% above average.
It's a textbook key reversal, a massive bullish engulfing candle. Institutions use algorithms and dark pools to passively absorb all that retail panic selling at $40.
Right.
And once the sellers exhausted themselves, they overwhelmed the order book. That shows you institutions are highly active in picking up structural buys, as long as it's not tech.
So we've survived the chopped-up holiday tape. We've decoded the AI fracture. What is the institutional look ahead for tomorrow? What's the play for Thursday, July 2?
The baseline expectation is more range-bound, highly illiquid chop. Internal models have a 40% probability of a downward continuation.
So likely consolidation. What are the key mechanical levels we need to watch?
The market absolutely must hold the 7,450 support line on the S&P. That coincides with the 50-period moving average. If it cracks, mechanical selling could accelerate. On the upside, the ceiling is the gamma wall sitting between 7,500 and 7,520.
Right, because as we approach 7,500, options market makers are mathematically forced to sell the underlying stocks to hedge their own risk, which caps the momentum.
Precisely. Now, as for specific day 2 plays, we're watching 2 setups based on today's action. First, a meta continuation breakout. Watch that $620 level, or look to buy a morning dip at the new $600 to $605 support zone.
And the second is the other side of that coin, right? The Micron short flush.
Yeah, Micron breaks below today's $1,032 intraday low. The target is a rapid algorithmic drop down to the $1,000 psychological level.
But there is a massive wild card hanging over all of this for tomorrow morning. The June Non-Farm Payrolls report is dropping a day early because of the holiday.
And it is going to dictate the entire July narrative. It will either validate the cooling labor market and give fuel for rate cuts, or it's going to run hot and force Fed Chair Warsh further into his corner.
Right. And in an illiquid tape, any surprise there could be violent. So as we wrap up this deep dive, I want to leave you with a final thought to chew on regarding the tech landscape.
Go for it.
We've been watching this AI story unfold, assuming the companies building the picks and shovels are the ultimate winners. But as Meta pivots from burning cash on infrastructure to suddenly becoming an AI cloud provider themselves, ask yourself, are we nearing the end of the AI hardware gold rush?
That's the million-dollar question.
Right. Are we entering the era where the tech giants fiercely battle over who actually gets to monetize that hardware they've been hoarding? Keep questioning the headlines, and thanks for joining us on this deep dive.